Welcome back. The market is suffering from what my next guest calls a three-body problem, thanks to a strong dollar, rising yields, and narrow breadth. And he says until those conditions reverse course, downside volatility for stocks will continue. Let's bring in Jonathan Krinsky, the chief market technician at BTIG. So it's like a physics thing, Jonathan. I thought it was like a psychological condition.
Well, it could be both, but as you mentioned, Kelly, we've had that persistent push up in the U.S. dollar, up 13 of the last 14 weeks. Interest rates at in some cases, whether you're looking at real or nominal rates at the highest level in 2 years. And we had that persistent weakness in breadth in December. In some instances, it was some of the weakest breadth we've seen on record. So, it's really difficult for the market to make upside progress when all three of those are occurring, despite the fact that, some of the heavyweights, the typical heavyweights in the Mag 7 continue to, hold their own at this point.
Do we need the third, like if it were just the dollar and yields, would that be enough to kind of be a problem in and of its own?
Well, it's kind of, I think the weak breadth is a reaction to the strength in dollar and yields, right? And because you're seeing it impact the small caps, you're seeing it impact the broad market the most, whereas the Mag 7 tends to be the least impacted by rising interest rates. We saw that, in 2023 and part of 2024. So, it's all, correlated. It's all related to each other. And I think, the hope for the bulls is that washout in breadth that we saw in December is an opportunity, and we can see breadth rebound. We're certainly seeing it today. But I think for that rally and the breadth broadening to have any sustainability, you really need to see rates and the dollar not only probably pause, but really pull back lower, and we just haven't seen any signs of that to this point.
Absolutely. And if Santa Claus should fail to call, bears may come to broaden wall. That makes me think of the late, great Art Cashin. And that gives you, among other conditions you're citing, some reason to think we might have some near-term downside.
Yeah, so that Santa Claus rally, it's often talked about. Today is actually the last day of the period, and barring a miraculous rally, it's probably going to be a negative Santa Claus rally period. Now, that doesn't necessarily mean, the rest of the year is going to be awful. There's been plenty of times when we've had a negative Santa Claus rally and the year has been actually pretty strong. But all else equal, a negative period does portend to lower than average returns as opposed to if the rally is positive. So you have that. The next indicator we're going to look at is the first 5 days of the year. So we're actually up, over the first 2 days. So that's a good start. So, it's always tough to make too many calls over the first couple of days of the year. But I think, over the last few months, the issue has been, really since the Fed began cutting its cutting rates, you've seen breadth actually narrow as opposed to what I think the consensus thought it would expand. So that's really the issue, and that's got to resolve itself for us to move materially higher.
Kind of on the flip side of this, because obviously big tech has been where the strength is, but again, a little bit of a different picture the last couple of days. Apple started out on a poor note yesterday. We had a guest earlier this hour who said he was surprised it didn't trade better today in response to some of the stimulus measures that China's introducing. And you think, after a really strong finish to the year, that where would you be looking maybe for an entry point if this correction continues?
Yeah, so it's funny. Apple we highlighted this in late December. It was almost too much of a good thing. It had been up 5 consecutive weeks, 2% or more each of those weeks. And that historically has been a pretty bad sign for the next month, meaning you just kind of pulled forward a lot of the strength, and you tend to see average returns actually in the -5 to 6% range over the next month. We've actually seen that just over the last week. So it's possible it kind of did a lot of the sell-off just in the last week or so. But I think, Apple down around 225, 230 is probably better support. So it's been a decent pullback, but probably a little bit more to go as we head into the bulk of January.